even if you're not fully cash, you don't have to be fully equity, you can be somewhere in between. That's diversification, and if you're unsure, that's why you should come and speak to us. Hello and welcome to the Walker Crips Podcast. I'm James Richards, Investment Director in the London office.
And I'm Ben Potter, Investment Manager in our York office.
So Ben, let's get into it. What's been going on in the markets?
It's been, in terms of news flow wise, considering what we've had in the whole year up to now, it's kind of been relatively quiet compared to some other periods. But I'd say one of the main things that's caught my attention has been the AI contraction, I'd say. So we've seen a lot of tech stocks pull back a little bit in the past couple of weeks, which I think is what we were saying in the first time, wasn't it? That investors are looking at it and seeing that, right, where are the margin improvements going to come from? And I think that's led to a bit of a decline. Have you noticed the same thing?
Exactly, particularly in Korea, which I think we have mentioned before. Samsung and SK Hynix, the two largest companies in the Korean index, have seen big movements, both positive and negative this year, a lot driven by leveraged ETFs in the two stocks. And that's led down US AI-related tech stocks as well. Thankfully, as we were saying, there's not been a huge earnings issues come through so far. It has just been news, and that's sort of par for the course in terms of markets.
So we're looking at those companies in themselves, and it's where the expectations are, which is what investors are looking at. And they've seen such phenomenal growth. I mean, no one can argue with the figures that they've been pulling out and been delivering on consistently for quite a long period of time now. But I think people's expectations are slightly beginning to waver a little bit, and that's what caused the multiple contraction, which is one way of looking at investments, which a lot of investors do. So if you look at it purely on a simplistic basis, on a price to earnings, if you think it's got really strong growth potential, you might value it at 50 times earnings, which is quite expensive. Whereas if you don't have those earnings expectations anymore, you might bring it back down to 30 times, which means the share price is going to decline. So I think we're seeing a little bit of that at the minute, which has been the main focus and driving the movements that we've seen in the markets. But whether you've seen it or not, I think the value side has been quite noticeably having more flows come into it than the growth side recently.
The UK market, the FTSE 100 being the biggest constituent, is quite a value-orientated market. And so actually we've seen some good numbers there from a number of those companies. When we say value and growth, just for context, value very simplistically would be on a multiple basis, less than the market and growth more. There's clearly more to it than that. But seeing the FTSE and a lot of FTSE constituents do quite well. Have you got any particular names that are catching your eye?
Well, there's been plenty. I mean, one that's been very interesting has been, like, you look at BP and Shell, which have been in the news a lot recently, which comes on to maybe another point to discuss, which has largely been the oil prices. But I think even if you go down a little bit further and look at a British American Tobacco, for example, if you look at those types of businesses, they're highly cash generative businesses and typically trade on lower valuations. Yes, they pay a dividend yield, so you could look at Illegal and General or the banking stocks, HSBC, for example. That's been a very strong performer throughout the year, sort of thing, year to date. So I think we've seen all these types of businesses who pay out more of a dividend, which is important to investors. One area of return that you can generate an income from in this regard, or generate a return from. And we're seeing less investment being focused on the actual just growth multiples. So companies who are reinvesting their profits, reinvesting their earnings back into the business. That's had a really strong period of growth. And I think people are now taking a bit of profits from there and allocating back to more defensive areas, which is what we were just saying about the value side, isn't it?
It's important to say, though, that not all value is defensive, and there can be value traps, that something looks cheap and you think, oh, that's quite attractive, but it could be cheap for a reason, that it's actually not very good and it's in decline, perhaps structural or company specific. So people need to be cautious of that. Going back to BP and Shell, though, and the oil price, we've talked about this in almost probably every client meeting I've had, and I expect you have as well this year. It's fluctuating all the time. I'm reticent to timestamp what the price is now because it moves so much. And with President Trump's tweets seem to affect it so much. But how do you play this?
I think it's a very difficult one to play in today's world, where we're seeing price swings of significant amounts going from $80 to $100 in pretty short periods of time. Are we able to time the market and know when kind of these swings are going to happen? I mean, the fact, as you just said there, a President Trump tweet can cause such drastic impact. I think it's difficult to say that I or we as investment managers or whoever it is as an investor can effectively time that consistently. There are, of course, some methods, and if you're into technical analysis, you might be able to find certain ways to time, but that's a whole different area, and I can see arguments and against that. I think if you're looking for consistency of returns and looking at long-term portfolios and wealth generation, which is ultimately what we look to do, and wealth preservation as well is also an important aspect. I think the key is maintaining exposure and not almost being reactive to each of the daily swings. It's we've got exposure to, whether that's through BP, whether it's through directly having some contracts for oil or whatever exposure you've got. I think you've got to maintain a long-term view with oil and not looking to just capitalise on the very short swings. Of course, if you see it $140 a barrel, it might be time to take a bit of profits from BP if the price has gone up, and then you can re-enter at a lower level. Like, you can do a little bit of trading, but
in the whole, it's time in the markets, not timing the markets.
Completely agree, and that's almost the philosophy that we try and go by, isn't it? And what we're taught's the right thing. So
one thing that is prevalent and sort of more interested from an investment point of view is the inflation effects of higher oil. We're seeing that. We've seen gilts this year have come back and sort of settling short-dated gilts all the way through to longer-dated are settling it in the 4+% return. That's making them a little bit more attractive than they have been of late.
Yep, completely agree. And that's one of the most important conversations I'm having with clients at the minute. And I know we are across the business. I mean, you look at the actual net return that you get when you take in the tax considerations on something like a gilt, which I'm pretty sure we touched on last time. But as a reminder, it's if you can buy a government bond, let's say, at £95 per nominal, let's call it. And it will redeem at 100 at the maturity date. That £5 difference, that capital growth, is exempt from capital gains tax. So it can be a very effective way of getting a strong return, whereas if you've got £1 million in cash or whatever sitting there in an interest-bearing account, you might be paying quite a lot more in tax than you necessarily need to for the similar level of risk. There are, of course, scenarios, and it's tailored to everybody's individual circumstances, but it's one potential method that you can look at of generating more return for relatively little extra risk. So we've been having lots of conversations about that, and I think they're a cornerstone item that we're having within investors' portfolios at the minute.
I'm seeing that exactly the same with my clients' portfolios, both for those who have got money on the side, be it for a house purchase or a tax liability, but also as part of a balanced portfolio and having that diversification with the higher risk equities, be that UK, value, global growth, but also just having some sort of security or risk-adjusted returns in the portfolio.
And I think the other key element to think about with that as well, isn't it, is that they actually act as a bit of a portfolio stabiliser, which, as we've talked about previously, it's nice to have that diversification. And these elements, when you're in such a volatile period, which we've seen large equity swings on all directions, whether that's the S&P 500 due to the concentration risk, by having some of the gilt exposure on a 2-year short-dated gilt, it holds up pretty well. So let's say we did have a market crash, we could potentially look to sell some of those and enter the equity market at a more attractive level, which I think that's quite a sensible approach when you're still getting 4% plus returns. There's plenty that we can do at the minute, isn't there? And it's just looking at the right products. But I think overall this volatility has been a relatively good thing.
It brings opportunity.
It does.
For us as investors, long-term investors, can be quite good. It's not always as scary as it seems in the headlines. That said, Andy Burnham, our new Prime Minister, has come in since we last spoke, announced a new Chancellor. Not scary or volatility in the markets because of this, which is seen as a good thing. How do you take that?
It was all very uncertain, wasn't it? And everyone kind of knew the direction that it was going in, and we all had, it was heavily documented in the news, wasn't it? It wasn't exactly a shock. But I think it's been interesting watching the market reaction to it. There hasn't really been any signs of a real lack of confidence in Andy Burnham here. And even as he started drip feeding some thoughts coming in, whether that's changing the stamp duty policy, etc., and adding almost I want to call it a property value tax, which has been widely documented. I mean, it appears now that that's not going to happen. But if we look at the market previously reacting to it, it's all been relatively positive. I mean, I'd say the FTSE 100 has gone from 10,500 to 10,900-ish. That's quite good to see. We're seeing some good returns coming in still, which I think is more of the general broader equity dynamic, but it's also showing that there's a little bit of faith in the political standpoint. So long may that continue is what I would say.
I think it's interesting as well to think of the FTSE 100 and the FTSE 250. So the 250 being the smaller companies below the top 100, because the 100 is quite focused on international businesses. The number changes a lot, but it's more than 50% of revenue of those companies comes from overseas. Yeah. So whilst that might be being positive, it doesn't necessarily reflect the UK as an economy. So the 250 is often more representative of how that's doing, but there are also positive numbers further down the market scale.
It's not the best comparator of the UK economy as a whole, for sure, but it's an interesting point where you look at it in comparison to international peers, and it's good to see that the UK is getting a bit of investment now, which hopefully we continue on that equity bull run in the UK, which is nice to see, of course, as investment managers. That's what we want to see. But it's going to be interesting to see what policies come up in the future, tax announcements, etc. And there was a lot to unpick from the previous ones, which a lot of people are doing a lot of planning for now, which obviously we work closely with individuals and companies, trusts, etc. And there's still lots of planning that's being had, whether that's the pension reforms, which we've seen lots of. So I think there's still lots of change that will happen and could happen, but it's yet to be shown, hasn't it? So we'll just have to wait and see.
Play it as we see it, be prepared for all eventualities as always.
Whilst it's all speculation, I think it's hard to make decisions, is what I've been having a lot of conversations with clients about, asking, well, should I be doing this? Should I be doing that? And I'm a big believer if the fact isn't there, it's not a fact yet, it's on speculation. It's as much as a gamble as anything. And we can't I wouldn't feel comfortable making decisions on facts you don't know. So I think wait up until everything comes out. Policies normally take quite a while to change, and it's important to make sure you know all the details before making decisions.
It's exactly the same with tax changes. We see this time and time again. Is there going to be an increase to capital gains tax? Is there not? The pension changes that happened a few years ago and more to come. You can't go on the speculation. You need to wait, and also don't let the tax tail wag the investment dog. Yeah. Make sure that you're investing in a good investment. If you have to pay a bit of tax on it, that's generally a good thing because it means it's gone up. Yeah. And be conscious of tax, be tax efficient wherever possible, yeah, but make sure you're making the right investments as number one priority.
Yeah. And I think the other key factor of that is I'm speaking to a lot of people about cash balances at the minute, which I'm sure you're the same in that regard, but there's a lot of people sitting on a lot of cash at the minute, which is largely, I think, as a sign of not a lot of confidence in markets. And as a nation, I think we do all have a lot of cash, which if we look at all the statistics that we've looked at historically, etc., it shows that equities over the long term do outperform cash, and cash can often be eroded, the returns you're getting from it, even if we're saying 4% now, 5% now, whatever you're able to get in those cash wrappers. They've historically always underperformed inflation. So it's interesting to see, and I think we're having lots of conversations of trying to emphasise what a balanced portfolio can look like. And yes, you might be overweight cash for the short term, which I think can be a sensible idea if it's the right thing for you, etc. But you can also look at different types of returns that you can get to maximise your wealth, which is a key topic.
Exactly. I think as you said, as a country, we are underinvested. And that's something that there has been talk about policy change, and I would be supportive of that, as I'm sure you would. It's our job. We want to help educate clients and get more people invested. It's really important that everyone has an emergency cash pot. Don't invest every penny you've got, because you need to be able to fall back on something should the worst happen. But far too many people have too much in cash and aren't investing. Investing isn't just equities. You know, as we've talked, that's the main driver. We hope the best returns in the long term, but there's a wide range of assets that people can be invested in. And so we want to make sure that even if you're not fully cash, you don't have to be fully equity, you can be somewhere in between. That's diversification. And if you're unsure, that's why you should come and speak to us.
And I think it's that portfolio construction, isn't it, ultimately, which forms the full type of asset base that you've got, whether lots of people as well have lots in property, for example. I mean, I'm having lots of conversations about the new landlord reforms, for example, and there's extra responsibilities as landlords, as some people are, some people aren't. It obviously changes it depending who you speak to. But some people no longer want that responsibility of being a landlord, and therefore they're asking us the question, well, what does an investment portfolio look like? It's certainly worthwhile considering, isn't it? Because if you're freeing up that amount of capital, etc., you want to make sure that it's working for you. So there are lots of things that you can do, but it's having a balanced approach and a balanced exposure across the board, isn't it?
Absolutely. Ben, thank you for your time.
And you, James, a pleasure as always.